That's obviously always going to be a high volume spike. The two biggest volume spikes of the day were both at 42 price. The 42 price that we told you about last night in the tweets. They both reversed the S&P marketplace. Both of them. Pretty impressive. Pretty impressive stuff, right? You'll be saying, damn it, so it is. Because obviously it's difficult to catch that falling knife and it's difficult to catch that falling knife, but you do have the opportunity to lean. You've got the opportunity to see a seller getting jammed and then lean against them, and you've got an opportunity to see a seller getting jammed and lean against them and take the trade on. You might want to wait for the buyers to show up and then wait for the break lower and wait for the reversal to take place, wait for a spring trade. So you might have been buying here instead. You might have been buying into this change here. Okay, there's no problem with that. But at least you know what you're doing in the right locations when they're happening. Very, very important stuff, guys, in terms of volume analysis. We did a classroom on time segmented volume. We've done this classroom many, many times in the past. But again, I wonder how many people are using the information. I wonder how many people have stopped using the information. Maybe they used it for a few days, then it dropped off their charts, and then they're just back to square one again. So we've got to keep rattling over these things. This is what happens when you're not sitting in an actual prop trade environment where everybody's in the room and they're all taking trades and I'm walking behind you, instead of which you're kind of looking in from behind. I don't know what your guys are doing because I'm not visibly seeing what you're actually actively looking at. There's a big difference between prop. Prop is you guys on the desk and me watching. This room is you guys watching with me on the desk. Whether you implement any of this stuff becomes your choice. It becomes your information to forget or not use. And that's the biggest problem we've got in an online environment. The biggest difference is I don't have the ability to walk behind you with a ruler and tap you on the shoulder, perhaps, and say, why are you not using volume? Why did you not see that volume? Why did you not see that value? Why did you not see this developing? So, it is what it is within the limitations, but that's why we always suggest that if you type in the box about things that you're doing, we can obviously look at it and try and give maybe some insight into some of these trade ideas. But welcome in, guys. In terms of data, it's relatively busy for a Monday, but nothing particularly market moving. The Chinese GDP numbers did come in softer than expected at 4.9%. However, they did beat on their retail sales expectation. They were expecting a 3.5% pop on retail sales, coming at 4.4%, but their GDP quarter on yearly dropped to 4.9 against a forecast of 5. Not the biggest drop in the world, but investments dropped to 7.3%. Industrial production also dropped from 5.3 to 3.1% on a year-on-year basis. But remember, you're still using simply some of the unusual benchmarks in the background. When we're moving forwards to the US session, we do have industrial production numbers at 2:15, nothing out at 1:30 today, which is obviously the usual big data release. But 2:15 industrial production numbers. Remember, that's an unusual time, and it sometimes catches people out. So just make sure you're switched on to that industrial production number at 2:15 today. 3 o'clock housing market index numbers. Not the most market moving, as you know. And that's pretty much it for the day. Tomorrow, in the overnight session, we've got the Aussie minutes, which are going to be quite interesting. Going through the day, there's not an awful lot building permits and housing starts for the US in the afternoon session. Nothing out of Europe at all. Lots of Fed members from 4 o'clock onwards tomorrow afternoon, tomorrow evening. So potentially market movers. And then the next day on Wednesday, we're starting to look for CPI numbers from the UK and from Canada. Very, very important inflation numbers out of the UK. 3.2% forecast on Wednesday. So big bond market information coming out on Wednesday that we want to try and take advantage of. So Welcome in, guys. Not a lot we can read into this morning's markets. We talked about the volatility, which you may or may not have remembered about, but volatility at this time of the month obviously has dropped off to the historic lows that it does. We show you this chart after this chart after this chart on many occasions. We've done classes on it, several classes. And we tell you to always be aware of the fact that we're probably going to get a spike in volatility. And due to the rotation in calendar spreads, people will roll their volatility positions, which means volatility gets very cheap, which means there's a lot of hedging takes place, which means equities are more likely to sell from highs. And obviously, in the vast majority of occasions, equity does come off. Whether it sells off or whether it just tops out for a few days doesn't make much of a difference. But we told you this last night, interestingly enough, Kim. We told everybody last night that this was the low on volatility and they would be buying into this storyline for a sell top edge equity. What happened? We sold off the RGL, and the RGL S&P last night dropped $40,000 all the way down to the advised bracket low from the strikes. You couldn't make it up because it's all tweeted, it's all time-stamped. You'll be able to see that for yourself if you can read and put together the storyline and put together a trade based on that storyline. You've just found the sell trade for $1,000 based on that narrative. And you can see in the background on the S&P, you can see that from last night's restart, you can see from last night's restart, from Friday's closing price areas, you can see we've had a very nice sell-off, and coming off the RGL in here, and all the way down to this, spike area in terms of the volatility that you get from the strike prices, the liquidity we get from the strike prices, and then the liquidity that's then visible at these strike prices based around the volume. We simply start to recognize some interesting opportunities. Putting one and one together, guys, is one of the most important aspects of trading, isn't it? Putting one and one together. If we can put one and one together, trading actually becomes quite easy. But that's the challenge, because it is a jigsaw puzzle. It is part of a jigsaw puzzle that we've got to try and work around. So welcome in, guys. I hope you're all good this morning. Not a lot to get started with this morning. The markets have been relatively rotational so far today. We've talked about duration. You know, it's a funny subject, you know, because of the impact that duration has on bond prices. But generally, as a rule, if bond prices are dropping, duration is falling, and we should obviously be able to recognize that from as a very simple chart. But understanding duration is important, because a lot of people wonder if duration's falling, is that good for equities or bad for equities? It's not the question. That is not the question. It's the nature of the duration, where we are in terms of the marketplace. So it's a subject that, you know, you can't use it unless you understand it, because it's got a whole heap of problems in the background to try and understand. We talked about gold at a bottom edge this morning. You'll see what happened to that gold trade after the exit price. The bottom edge has turned into a very nice upside. We're coming back into that commercial sell zone in the background here. You'll be able to see that we got a big spike in volumes and the price stopped. Profit takers pouring into gold just at that stage there after a very effective long accumulation. And you can see that very effective long accumulation through that period, resulting in exactly what just happened, the upside pop. So we went from 60s to 69, 70s, almost $1,000, not quite. Pretty damn good. Pretty good trade, right? So welcome in, lads and lassies. Welcome in. I hope you're all good this morning. We've touched on volume. Interesting that we did the volume analysis on oil this morning. We talked about that sell. Did anybody see what happened to the sell on oil? This is what happened to the sell on oil. We came in earlier. We were talking about oil down here for a sell. It made 7 or 8 ticks and it scratched out. And then we waited because the volume came in. We saw the volume coming out. We sold oil again, and it went from 83.20s to a low price of 82.75. This was live in the room, by the way. 82.75. That's a 45 tick profit. That's a $450 profit on that selling of oil. And again, another brilliant outcome. You can see that we got a very nice divergence into the retest in here for the walkaway trade, and that's been it so far. So using volume analysis and developing out the various volume scenarios using time segmented volume is what we covered in Classroom this morning. And you know, we've done classes on time segmented on the types of signals that you can use time segmented volume for. But when you add that all together, it's a very, very powerful piece of information. But we'll certainly cover that in the Monday Club again this afternoon, as well as the designated market makers. The designated market makers. Remember, we're not talking about volatility when we're talking about these specialists. These are the other specialists in the marketplace. These are the actual stock specialists, not the volatility specialists. So that's why we're calling them DMMs, so that you have a difference between the specialist line, which is the volatility line, and the other specialists, which are stock trading specialists. Anyway, welcome in, guys. We've got a lot to cover in Classroom, 4 o'clock, and we'll obviously be looking at the NASDAQ on a short term. I must remind myself to set up that chart because I haven't got that chart ready before Classroom, and we'll get started. We may start shouting out some DMM activity as early as possible so that you can start to watch to see what happens to price when you see the DMM activity on the Qs, and then we'll obviously be able to look at that going backwards as to what we shouted and see ultimately how it transpired about what the DMMs were doing, whether they were bidding or whether they were offering, and we'll obviously be able to cover that in Classroom so that it makes more sense once we get into the Classroom proper. So welcome in, guys, welcome in. I'm going to grab a little bit of lunch, nothing out for the US, so a quiet start to the US session, and then we'll get started into the meat of today's markets at 2:30.